the problem with Warren Buffett's vision is he's looking in the wrong place. He's looking for other currencies.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
Gold rallied. Again, why? Gold is an inflation hedge. So gold should rally when inflation is higher than expected, not lower. But in the perverse world that we live in, everybody is focusing on the Fed. Lower inflation means the Fed can cut rates sooner, and that's perceived as being good for gold. Higher inflation means they can't cut rates, and that's supposed to be bad for gold. The reality is high inflation is better for gold because gold is an inflation hedge. And what high inflation shows you is not that the Fed is going to have to fight harder to win. It shows you that the Fed is losing the fight against inflation, and that is bullish for gold. So traders still have this whole thing wrong. That's why whenever you see a sell-off in the price of gold on hotter than expected inflation numbers, you want to buy into that dip. And in fact, gold, which was up $10, $12 early in the morning, sold off. It was down better than $10 when the market sold off, when people started to think, oh, wait a minute, this isn't a good enough improvement. Maybe we won't get the cuts. And then gold sold off. So it's always making the wrong move, but it was still a buying opportunity. As I'm speaking right now, gold's trading around $2,033 an ounce. It ended down maybe a couple of bucks at the end of the day, and now it's regained that. It's up about $3 in the evening. But one of the other reasons that we might have seen a sell-off in the price of gold today was some supposedly tough talk on inflation coming from Christine Lagarde out of the ECB, who in an interview said we're going to have to hike rates at our next meeting because inflation is still a problem, which is a massive understatement. The year-over-year CPI in the Eurozone is 7%. That's down from its highs, but it's still well above the 5% that we've got in the US. So they're at 7%. But the ECB still has its main interest rate, its deposit rate. It's 3.25%. We're 5.25%. So we're 200 basis points higher, but inflation, the way they measure it in Europe, is 200 basis points higher. So the interest rates in the Eurozone are still negative. You're at 3.25% rate and 7 inflation, right? You're 3.75% negative rates. Now the US, finally, we actually have a slight positive rate. We got 5.25% Fed funds, and we got 4.9 inflation. So it's slightly positive. Now, of course, after tax, it's still negative, which I think is more important because a lot of people are paying taxes on the interest that they earn on US Treasuries. They're paying federal tax on that interest. Well, you don't get to deduct inflation from your tax. So if you're collecting, let's say, 5% pre-tax, and after tax, you're left with 3%. Well, if inflation is 4.9, you got negative rates. And so a lot of people still have negative rates on an after-tax basis, which is really what's important because that's what you get. You get the after-tax yield. You don't get the pre-tax. So that's what's more important from the perspective of the lender. But of course, all the rates are negative if we use a real inflation rate. They only appear positive because the government is lying about inflation through the CPI. So rates are still negative everywhere, but they're even more negative in the Eurozone. So clearly to raise rates, but it's not going to work. They're not going to raise rates enough to fight inflation in the Eurozone either because all of the budget deficits throughout Europe are continuing. None of these governments are cutting back on their spending, and all of this excess spending has been accommodated by the Fed, by the ECB. Without the ECB's 0% policy and their asset purchase program, a lot of these countries would have been forced to act fiscally responsible. The reason they didn't have to do it is because the ECB enabled all this profligacy, which has unleashed all this inflation. Inflation is the consequence of all these deficits that were paid for by the ECB. And now the Europeans are going to be living with the consequences for years and years to come. So it doesn't matter about all this tough talk. Inflation is a problem that's not going away in Europe, and it's not going away in the United States. Now, one person I think who understands that inflation is a problem is Warren Buffett. And the reason I want to talk about Warren Buffett is because they just concluded their annual meeting for shareholders of Berkshire Hathaway. And during that annual meeting, Warren Buffett was probably as pessimistic as I've heard him. I mean, he's normally kind of like a cheerleader for the U.S. economy and for the markets in general. But he had a somber tone at this meeting. And he forecast tough times for the market, for the economy. He said that most of his businesses, he expects to see some earnings weakness. And so, he is worried about the economy. And one of the reasons he's worried is because of inflation. And he has talked about owning Berkshire as an inflation hedge because it has real businesses, real assets. A lot of people think that Warren Buffett doesn't like gold because he says that gold does not compare favorably to stocks as a long-term investment. And I agree with him. Gold is not an investment. Gold's money. Gold's a commodity. An investment is a business that generates income, or it's investment property that generates rents, right? That's an investment. Gold isn't an investment. You can own gold. It's a store of value, but it isn't going to generate returns for you the way an investment is. So Warren Buffett doesn't like gold as an investment, but he does prefer gold as a currency, as a store of value to dollars or euros or yen. But Warren Buffett doesn't just hold a lot of cash, although now he is. And in theory, Warren Buffett should be exchanging his cash for gold, because the reason Warren Buffett is holding a lot of cash is that he thinks stocks are going down and he wants to hold some dry powder. He really should be holding his dry powder in gold, because I know that Warren Buffett understands that as a store of value, gold is better than cash. Now, maybe he thinks that earning 5% in a money market, that's better than earning 0 in gold. I don't think so, because I think gold is going to rise by more than 5% a year, given all the inflation. And so that Warren Buffett would be better off keeping his dry powder in gold than in cash. And the reason he's doing that is hoping to buy actual investments in the future at a better price than he could buy those investments today. I think it would be better for Berkshire shareholders if he did that using gold, not dollars. And maybe at some point he's going to start doing that, because he doesn't dislike gold as an alternative to the dollar. He just dislikes it as an alternative to stocks, dividend-paying stocks. And over the long run, he's right. Over long periods of time, if you're a smart investor and you buy good businesses cheap and collect dividends, you will do better than just holding gold in a vault. But over short periods of time, you may do better holding gold, depending on stock valuations, where you are in the business cycle, what's going on with inflation. And I think Buffett might figure that out. But one of the things I was laughing, because I was watching on CNBC, and all of the Bitcoin shills that work there were talking about Warren Buffett, and they're making fun of him because he's still negative on Bitcoin. And they're saying, he says all these crazy things about Bitcoin. No, he doesn't say anything crazy about Bitcoin. Everything he says about Bitcoin is perfectly sane. But these guys are dismissing him. They're entertainers. They're journalists, right? I mean, this guy is supposedly the oracle. He's one of the most successful investors in U.S. history. And these guys are just a bunch of reporters who are, / entertainers. And they think that this guy has nothing valuable to say. Now, one thing that Warren Buffett also spoke about at the shareholder meeting is he weighed in on de-dollarization. A lot of people are talking about the dollar losing its reserve status. And so Warren Buffett, I don't know if he was asked about it or if he just opined on it, but Warren Buffett said on that score, he doesn't think that the dollar is in danger of losing that because he doesn't see any other currency that is positioned to take the dollar's place. And again, on that, I agree with Warren Buffett. I don't think that any currency should replace the dollar as the reserve currency. But the problem with Warren Buffett's vision is he's looking in the wrong place. He's looking for other currencies and seeing, well, there's problems with the euro, there's problems with the yen, problems with the RMB, and so the dollar is safe because these other fiat currencies, they've got problems of their own. Well, he should look beyond fiat currencies, again, to real money. The alternative that Warren Buffett fails to recognize is gold. Gold is the alternative. And in fact, look at the numbers. Central banks are now buying gold at a record pace. That information just came out. But despite the fact that central banks are buying gold at a record pace, they still don't own nearly as much as they have in the past. They have a lot of gold to buy to catch up to where they need to be, which is much, much higher than they are right now. So the world is already in the process of replacing US dollars with gold. And dollar did not replace another fiat currency. It replaced gold. Prior to Bretton Woods, all the currencies were backed by gold. Not another fiat currency, gold. And when the United States was able to convince the world to adopt the dollar standard, it was because the dollar was not only backed by gold, but convertible on demand into gold. $35 got you an ounce of gold. And then Nixon defaulted in 1971, right? All this talk about how the U.S. government has never defaulted. We defaulted on our promise to pay gold. Federal Reserve notes were notes. They were obligations of the U.S. government or the Fed to pay gold. We defaulted and paid nothing. So when you're supposed to pay something and you pay nothing, it's a default. So we defaulted in 1971. It's been over 50 years. And now I think the world is going to reject fiat dollars. We told the world that you have to have dollars without gold, and now the world is going to tell us, well, we don't want your dollars anymore. We're going back to gold. And so Warren Buffett doesn't see that, and a lot of people are missing that alternative. They just assume that the dollar is safe because the euro or the yen are no good, and they're overlooking what's obvious, and that is gold.